Say that. They say bear rips are always narrow. They say the 17.4% gain in the S&P since that June low was created mostly by four stocks, Apple, Microsoft, Amazon, and Tesla. They say they contributed 30% of that gain. So, Rob, I'm actually going to come back to you. Do you think that supports your argument that these four stocks, which are quality, are leading to so many of the gains?
Yeah, I would say that it does, right? Because there's bifurcation in every sector between high quality and low quality. But if you're just looking at the sector, estimates are too high in tech. Tech estimates have gone up, not down this year. In fact, the growth part of the market trades at 26 times. That is a huge premium to the market. And we think as liquidity tightens, it's no longer a place that you can hide in. You've seen hiring freezes, layoffs. The tech giants are questioning the resilience of their aggressive growth outlooks. And so not every business is created the same. And so when you look at what's happened to ARC recently from a performance standpoint versus what's happened to some of these other names, I think there's going to be and will continue to be a divergence in performance. So, you know, we recently added to Apple, and it's because Apple represents the quality within that sector. We added to it in March. It's been a long-term core holding. And, you know, since March, it's outperformed the market by like 35%. Right. So quality matters. I
mean, quality does matter, Shannon. So, I mean, I think the real question here is, can four stocks pull the market higher? Do they have more room to run? I mean, we're looking at some of the blue chip stocks, honestly, Tesla, Microsoft, Amazon. And we talked about a lot about valuations, all of them trading right along with forward PE, right about the NASDAQ, with the exception of Amazon at 112 times forward earnings.
Well, if we were talking about this a month ago, we would have said there's no way we can rally, actually, without these large names, save Tesla, perhaps participating. And so I think that the flip side of this is that let's just think about why these companies and why now. And if you need to engineer growth from a business perspective, if you need to be able to deliver top line and bottom line growth in an environment where we are entering into lower growth expectations from a secular perspective, then that is exactly the type of environment that we experienced, albeit with, you know, in some rising rate cycle, 2017 and 2018. So I think what investors are doing is that, for better or worse, they're looking back to the pre-pandemic playbook in terms of where did we get growth, top line and bottom line growth, what types of companies were able to engineer that. Companies that had a broad mix, like Amazon, in terms of technology and consumer businesses, strong brands. I couldn't agree more with Rob in terms of quality, but I think about quality associated with strong branding, which Apple is probably the one of the biggest, if not the biggest, well-known brand in the world. And so I think one of the things that we need to look at is this too far, too fast? Are we pricing in potentially slower growth, looking for these companies to be able to deliver that growth like they did in the pre-pandemic era, and not taking into account all of the existing conditions of supply chain disruptions, higher input costs, and perhaps a less than engaged or enthused consumer going into 2023. I think that's where there's a disconnect perhaps in the enthusiasm, for instance, for Apple right now, because a lot of what we need to see is happening in China from a production and consumption standpoint. I'm not sure we're quite back on track there, and I actually think that will be the catalyst for Apple going into 2023.